Well, I think we should get started. Welcome to this edition of the Bank Council Roundtable. Today's program is going to be on recent developments in commercial lending and finance. We will go, well, there are three of us here. Myself, I'm Joe Genereux, partner in the Finance and Restructuring Group. And with me are Peter Nelson, also a partner in the same group, and Erik, Detlefsen, who is a partner with us as well. So we'll have three parts to this presentation. I don't know that we're going to exactly maintain equal time, but we certainly will try to finish by 4:30 to be consistent with the schedule we've given to everybody. After the presentation, there's, for those of you in Minneapolis, there's some wine and beer and hors d'oeuvres if you want to stick around and have a bite before you take off. So with that, we've circulated materials. You've got it here in Minneapolis, and those of you who are online have access to that as well. I will say that that glow that's behind my picture just appeared mysteriously. I honestly don't know how that happened, and we think that was some kind of intervention. But in any event, we will move into the program, and starting it off will be Peter Nelson on trends in loan documentation.
All right, well, let's see if we can get that clicker to advance here. Thanks, Joe, and my name is Peter Nelson. As Joe said, I'm a partner in the Finance and Restructuring Group. I focus primarily on lending transactional work. I spend quite a bit of my time in the private equity, sponsor finance, leverage lending space. I also do quite a bit in the large corporate space and have quite a few clients in the agricultural and finance arena. So seeing the market from a lot of different places and a number of different perspectives, including some borrower representations. I know most of the folks here are bank lawyers, and most of what I do is representing lenders, but I think it is important to sometimes take these trends and changes in the market from the borrower's perspective as well, just so you can kind of understand what they're looking for. So I'll be speaking about recent trends in loan documentation, and most of what we're going to be looking at today is sort of how the market generally, and this is going to be primarily from the perspective of private companies in the upper middle market, the middle market, and the lower middle market. We'll be talking a lot from both the private equity sponsor perspective as well as general borrowers that are in this space, because the trends are pretty common amongst them as to what's happening. And so we'll start with the state of the market. We'll look at how the market is really starting to push documentation. And we'll finish it up with just some final thoughts and questions if people have them. So where are we? The middle market can generally be split. There's 8,000 ways that people look at, what's the upper middle market and the middle and the lower end. But, for purposes of our discussion, we'll kind of keep it with one of the more generic reference points, which is about $500 million to $1 billion in EBITDA for the upper middle market. So, pretty large companies with pretty big balance sheets. The middle market, which is generally, I think, where a lot of the Midwestern activity is going to be in this area, and that's $50 million to $500 million in EBITDA. And then the lower end of the middle market's probably more in the $5 to $50 million size. What we've seen and where the trends are starting is in the upper end of the middle market. And the upper end of the middle market really is driving the changes that we're starting to see. And a lot of it has to do with the M&A markets. One of the reasons that we're going to talk a little bit more about private equity sponsors than we might otherwise is that they are so often a significant player in the M&A world, but with the number of strategic buys that have been happening and the number of other companies that are looking for acquisition financing, they all tend to have some of the same attributes. And really what it comes down to is that there's a lot of money in the market. There are a lot of players looking to deploy funds. there aren't that many sellers, so in some ways pretty similar to our own local real estate market and many other real estate markets, where the multiples for quality companies are going higher, higher, and higher. In order for purchasers to afford that, they're having to borrow more and more money. With more leverage and higher multiples comes a lot more pressure on the good quality targets, who then get even higher multiples. And then from the investment side, it's got to make sense. And so they're looking to their lender groups to really stretch what types of financing are in place. At the end of the day, what that means is financing models are starting to get pushed very hard, and that's very difficult for commercial lenders. Commercial lenders in the regulated space are getting a lot of competition at this point from unregulated FinCos and other funds that are getting into the lending market. In fact, we're starting to see now private equity funds, who were typically just the buyers, now providing financing as well. And so it's changing the template, and it's requiring the regulated lenders to really rethink how they're going to approach lending in this marketplace, what they can do, what they can't do, where their niche is, and what they need to do to stay competitive. One of the other issues that comes up in this space, and one of the drivers for how commercial lenders in particular look at these types of transactions, is the regulatory guidance. Back in 2013, there was some the leveraged lending guidance that was dispensed, put pretty firm rules in place on what types of highly leveraged transactions commercial lenders could engage in, and how they had to allocate capital in order to support those loans. And frankly, it really changed the playing field significantly, because the unregulated FinCos and the funds could offer leverage at multiples that commercial lenders weren't, or at least at the time didn't think they were allowed to, and even now under current guidelines aren't sure that they want to. But what has changed, and maybe not surprisingly, with the change in the administration in October 2017, the GAO issued an opinion that effectively said that the 2013 guidance was in fact a rule, and therefore subject to congressional approval. The reason this is important is because when the guidance was issued, they didn't go through all the rulemaking hurdles, and therefore it hasn't technically been adopted as a rule. What that means is now it's truly guidance and not a rule. But at the end of the day, it hasn't really changed too many commercial lenders' perspectives when it comes to how they look at their own balance sheets, what they're willing to do. They're really not interested in moving too far away from the guidance. And the guidance really is going to keep leverage, at around 4.5 or 5 times senior tops. Really, it's more in the 3.5 to 4 times range. But with the advent of all these different funding sources in place, what we are seeing is that total leverage, often with either unitranche or sometimes first lien, second lien, or mezzanine, unsecured mezzanine, that we are still seeing some deals getting done in the upper end, again, of the middle market, in that 7 times range, 7.5. There's a couple recent examples. One got as high as 7.8. So this is it's a new advent for a number of these institutions. So at the end of the day, where this puts us is that we have a regulatory environment that has guidance, that has input from one of the 3 rulemaking agencies, but still no word from the other 2. So, commercial lenders continue to treat it as important guidance, but, it's not really a rule. We've got record multiples for M&A transactions, limited quality targets. We've got players from the PE space, from the hedge fund space, And most importantly, what we're seeing is a lot of strategics now involved as well, all pushing loan leverage profiles in a way that they've never been pushed. And with that has come changes in documentation that reflect that this is a buyer's market, or sorry, that this is a seller's market, and that buyers need their partners on the financing side to play with them and push the edges of what is permitted. So we'll cover a couple of these, but these are really notable trends in changes in the legal documentation that we've been seeing in the markets. And again, the driver here is the upper end of the middle market. Frankly, in the upper end of the middle market for large corporate transactions, as well as other leverage transactions, we're starting to see, the return of everyone's favorite covenant light. It's driving pretty hard throughout the market. And as the higher quality companies in the upper end of the middle market start to adopt these, and it starts to, ripple through the lending community, which includes all the lawyers that work on these transactions, it starts to make its way down into the middle, and then frankly, even in the lower end of the middle market for some of these. So we'll try and hammer through a couple of these that I think are more and more interesting. Some of these are more legal, and some of them, frankly, have a bit of a credit component to them. One thing we're seeing, and I think the overarching theme that we're going to see from a lot of these, is that buyers/borrowers want predictability. They want to know that they've got financing that is lined up and secured so that they can move quickly, whether it's on an acquisition, whether it's on a dividend recap, whether it's on whatever they have in mind for using the funds for, that they've got the commitments and the commitments are locked up. One thing that's come into the upper end of the middle market for sure, and we're starting to see it more in the middle as well, is fully underwritten commitments. And these can get very large. We were talking, beforehand, and, I think for a regional bank, or even, some of the commercial banks, for some of the larger banks here in the upper Midwest, a whole position of 25, 35, maybe $40 million, might be on the high side, or, right about in that sweet spot. Certainly for the community banks and some smaller regional banks, that's going to be on the high side. For some of these larger deals where you might be willing to put in 25, 35, maybe even $40 million. All of a sudden, what once was a club deal for, call it $120, $130 million, the borrower's just coming out and saying, we want one bank to underwrite the whole thing. You take the syndication risk, you take all of the other risks that come with that, you get the underwriting done, and we're just going to deal with you and you alone. We're happy to let you bring these other banks in. You've got the market flex. You've got, all of the other concerns that you might have. You're going to have to deal with them on your own, because here's the fee that we're going to pay you. Here's what we need from you. And if you want to be our bank, this is what you need to do. So that type of pressure is putting, the screws to some of the commercial lenders that are trying to play in this space, and frankly, it's pushing the credit approval process a lot faster than it ever used to go, because they don't want diligence outs. They don't want any sort of, legal outs. They want to know they've got a fully underwritten commitment and that they're ready to go. Similar concept is the accordion. It used to be that the accordion was kind of a nice to have. It was a bank group or even a single lender saying, hey, if in the future you want to borrow more money, and you can find banks to do it, we are willing to let you increase the size of this facility by X dollars, $15, $20 million. But really, the value was limited because you had to go out and find banks to do it. Well, borrowers are now pushing for fully underwritten commitments as this accordion. So that changes the dynamic. I mean, functionally, it turns into what is in effect a an incremental term loan where they're paying a small ticking fee until they exercise it. But what's challenging is that they're often using these in connection with acquisitions, and as all three of us see in the deals that we work on, They're building in a lot of protections. SunGuard is the one that you may have heard of, where effectively, as the buyer, they will negotiate their M&A transaction, and as the lender, you're required to fund their acquisition as long as their acquisition conditions are satisfied, even if there's technically a default under your credit agreement. So you're signing up on day one for a future funding obligation where you've got to fund as long as the conditions to the acquisition are met, even if there's a default that's ongoing in your agreement. As you can imagine, this is troubling, especially for the lawyers in the room, because we don't like funding into defaults. But it just goes to show, I think, where the market is in terms of the ability for borrowers and sponsors to really push what lenders might be comfortable with. And that's this basic acquisition-friendly terms concept is pretty much following on the same line. These guys are looking to know that they've got dry powder, and then as long as they can come up with the sources and uses, that the lenders are going to have to fund their pro rata share of any future acquisitions. Another trend we're starting to see, this one more just at the upper end, but it's starting to show up. I shouldn't say that so definitively. I've gotten 2 term sheets now that I'm looking at for companies that are probably $50 million EBITDA companies where they want to do dividends on a regular basis. And these are transactions that are highly levered. They're transactions that under normal circumstances wouldn't ever even be considered. But, we're not in normal right now. We're in, the new normal, which who knows how long it's going to last. But, as borrowers are pushing harder and harder, we're starting to see things that didn't seem terribly reasonable become the norm. So cure provisions, cure provisions really are... They're more prominent in the private equity space where you've got a sponsor who's not obligated in any way, who's not part of the loan and collateral support package, but who's the ultimate owner of the borrower and almost always has access to funds. Cure provisions started coming into most loan documents in this space probably about 12, 15 years ago. And at first they were added to deals almost because I think the lawyers thought it was cool to have a new idea in deals and without a whole lot more thought than that, because frankly, they weren't ever really used. But what we've seen recently is that these cure provisions are now starting to push the limits, similar to some of these other provisions, where all of a sudden a sponsor and owner of a company has the ability to cure events of default by granted they're putting more money in, so you'd think, oh, well, they're putting more money in, that's a win-win. Why wouldn't we want them to put, capital into the company? We don't have to. Well, because they're putting capital into the company under current terms primarily to, have more working capital. If you've got, a decent amount of your leverage in there as term debt, you might want that extra capital pay down some of your term debt and de-risk your profile. I can tell you as soon as they put that money in their minds, they've put new money in, and the fact that it went to operations and capital support for the borrower and not for paying down of debt service, they don't care. They're looking at it and saying, I just put several $1 million into this company to fix this problem. But on the upfront side, when everybody is, looking at this new relationship and excited about where it's going, you may not be so focused on what those terms are, but as the market has continued to push and it's becoming more and more common to have cure provisions curing and, going in as working capital as opposed to term debt reduction, things like that, it's starting to change the game a little and make, the workout groups within a lot of banks really think twice about how these cure provisions should be set up. And, more increasingly that, they probably need a second look from, credit in terms of getting credit approval up front. So this slide, there's just some ideas here to the extent that you ever run across a cure provision of some ways that you can try and limit the negative impact of a potential cure. Hit on one more topic, or two more topics here, sorry, and then I'll turn it over to Joe. But one thing that we've recently seen that just kind of blew me away at first was the ability for the borrower to actually buy a slug of its own debt. And almost every commercial lender has a rule in their assignment provisions that says borrowers are never going to be an eligible assignee. A borrower can't be a lender because obviously the conflicts of having a borrower in your lender group are, make your head spin. But what we first saw probably 3 years ago was the ability for borrowers to buy debt, but the requirement was they immediately had to convert it to equity. And the reason that they wanted this opportunity to buy the debt was so that they could take out a recalcitrant lender that just wasn't cooperating. Let's say they had 3 lenders and it was an amendment required unanimous support, and they couldn't get that support. It gave them the ability to take someone out. As that began to take hold in certain spots of the market, now all of a sudden they look at the opportunity and say, well, listen, instead of having to convert it to equity, we want to be able to hold up to 25, 30, 33% of the debt, and we won't have voting rights, so they'll be treated almost just like a participant, but they're still holding the debt. And now what that does, and what we don't know, is how's that going to be treated in bankruptcy? They're a secured lender at that point in time. And you've got rules set up within the agreement that says that they don't have voting rights. But bankruptcy kind of changes everything. And so it just leaves us, again, understanding that as borrowers and private equity sponsors and other players in the market are becoming more and more aware of where they can push the limits, you start to see that they want predictability. They want the ability to have the most protection possible. They're just frankly looking to protect their overall return on investment. And, they're looking to get seats at the table in ways that they didn't have before. Final thing I'll talk about is assignment provisions, because this goes to some of the same topics. But again, about 6, 7, 8 years ago, we started to see folks pushing on when a consent was required from the borrower. Because it used to be that if there was an event of default that was ongoing, borrower had no consent right. You might agree to limit the scope of potential assignees out of the gate, but that once the event of default was ongoing, the borrower was out of the picture and lenders could assign within the rules that everyone agreed to at the beginning. The reality is that they started pushing for having the ability to have what they call a specified events of default list. So now it's only really serious events of default that are going to prevent them from having a consent right over an assignment. And this list is starting to really get pushed pretty hard. I mean, there are some deals now where you'll see that the only event of default that will limit the borrower's consent right is a payment event of default or a financial covenant event of default. This list that I've got up here, and bankruptcy, sorry. The list I've got up here puts in a couple others that I think are pretty important and that I usually fight pretty hard for, because if you look at them, they're all really completely within the borrower's control. They are things that are fundamental to the transaction. They are issues that really are, core to what the deal is. But, as we've been seeing, they're getting more and more pressure here, the lenders are, to give on these points, and it's becoming increasingly difficult. There's a lot of people just having to swallow issues that are near and dear to their hearts. So where are we? We are at a very, very similar place to where we were in about 2006. At that point, covenant light was all the rage. We saw a lot of aggressive documentation trends at that point, a lot of very borrower-friendly terms, a lot of secured deals going unsecured, a lot of transactions that once required, full-blown credit support from an entire subsidiary family, only being secured with equity pledges. Those trends are starting to come back. We're starting to see it. And whether it means that we're getting towards the top of the market or whether this is just, another step in the ever increasing and ever upward push towards reducing protections for maximum flexibility, it's hard to predict. But the reality is that as you see this starting to slowly but steadily trickle down from the upper middle market into the lower end, it's going to be, becoming more and more common, and it's going to start trickling into the straight commercial transactions, even ones that might not otherwise have seen it. I'm starting to see, a real heavy push. And what it means is that there's a lot of discussion that needs to happen amongst credit approvers, amongst the front line, amongst the portfolio managers and legal, whether it's your outside counsel or in-house counsel, to really understand what it is that you're agreeing to, where you are at risk, and if and when at some point some of these deals start to go bad, what potential additional risks you've allowed, in order to get the deals done. Because the one thing that we understand is that our job is to protect you from risk and help you identify the risk, but that your job is to get deals done, or at least the banker's job is. And, we all have to work together collaboratively to understand what the risks are and how to best protect against them in the challenging environment that we've got.
So I think, as many of you know, LIBOR has been discussed as being a likely to be replaced by some other index at some point. And so that's the conversation we're going to have now for this portion of our program. To get to a bit of a level set, talk a little bit about the history and where developments that have been happening both on a sort of governmental and private sector basis. So LIBOR has been around since the mid-1980s, and it was put together and sponsored and overseen by a private sort of trade association, the British Bankers Association. And from the get-go, it was based on quotations from a panel of banks, I think the number is about 17, as to the interest rates that those banks were charging each other for loans between the banks on an unsecured basis. And it became a very popular interest index because it was announced on a daily basis. And so it became used really throughout the finance markets and in securitizations and in swaps as well as in commercial loans. But then in 2011 or so, there was a scandal that broke after investigations revealed that some of those panel banks were actually taking the information that they were learning from each other and using it to game the market, much to the profit of their financial institutions and the individual bankers who were engaged in the behavior. The result was multi-million pound fines to the banks, and they, in addition to suffering from that pain, they were the LIBOR administration was effectively taken away from the British Bankers Association. The financial authorities in the UK designated the Intercontinental Exchange Benchmark Administration, which I would call ICE going forward here. And ICE began in February 2014 to, again, reach out to the same panel of bankers, but were applying their approach to the determinations on LIBOR differently than what had been happening under the British Bankers Association. In 2016, ICE laid out a roadmap for how it was going to approach the determinations on LIBOR going forward. But then last year, in 2017, there was an announcement by the head of the financial authorities in Great Britain that said that ICE would stop using the panel banks in 2021 to make the determinations for LIBOR. Didn't quite say exactly what else was going to replace it. They had some proposals and described their process, but in any event, the approach that had been used and relied upon since the 1980s was announced to be replaced by something else. So that sort of set up the whole conversation about LIBOR replacement that we've been living with for the last last year and a half, I should say. Meanwhile, in the United States, the Federal Reserve Board established, out of concern that maybe LIBOR was going to go away, but also out of some dislike for the way LIBOR had been administered previously, established a Alternative Reference Rates Committee, which I'll call ARC here, in 2014. And in 2017, ARC, after having a number of meetings and discussions, selected the Secured Overnight Financing Rate, or SOFR, to be published by the Federal Reserve Bank of New York as a possible overnight index for determining interest rates. Now, as I mentioned, ARC has been convening a lot of meetings of regulators, banks, and industry participants, such as the Loan Syndications and Transfer Association, which those of us in the business know as LSTA, and to develop approaches and language that would work for ushering in a new rate, but also transitioning from the current reliance on LIBOR. They've also coordinated with the International Swaps and Derivatives Association, or ISDA, because because obviously the swaps that are based on LIBOR pricing are going to be affected by what happens with LIBOR. So that's sort of the background to it. And why it matters, the market participants believe that LIBOR or something like it really should continue. It's worked quite well. There's a sense that it's been a very efficient way of determining interest rates over the course of the last 30 or so years. But the belief is that the markets need a transactions-based pricing index that works with other money market rates to facilitate efficient pricing. That is, they don't want to have some rate dictated by a governmental authority or another entity that might have something other than a market determination to it. And then, as I note in the materials, there are trillions of dollars both in securitizations, in syndicated and non-syndicated loans, and CLOs and the like, and also, as I mentioned, swaps that are geared to LIBOR. So a replacement has to be something that will work reasonably well in all those settings. So to walk you through a little comparison on LIBOR and SOFR, as I noted, LIBOR reflects the rates at which banks borrow from each other on an unsecured basis, and that's an important aspect to keep in mind as we discuss the two approaches. It's calculated in multiple securities, including the US dollar, the euro, the Japanese yen, British pound, etc. And as I noted, there are 17 participating banks. Now, the banks have not reported actual transactions. What they've done is that the contacts at the banks, and thus their ability to have inside information, were these sort of market experts who were determining in their expert judgment what the rates were that were going on between the banks that they were representing. But it was not actual transactions. Now, as a technical matter, LIBOR is published daily at 11:55 a.m. in London, and it covers multiple interest periods, an overnight rate, a 1 month, 2, 3, 6, and 12-month rates. Now, there's a possibility LIBOR is going to continue. As I said, ICE said we're not going to use the panel banks anymore, but it didn't say we're going to stop using LIBOR, and indeed, or stop announcing LIBOR. And indeed, they have talked about something somewhat similar to where SOFR is going in terms of looking at actual transactions rather than looking to the expert judgment of bankers. So by contrast, SOFR is a US-based financing rate or index rate. The Federal Reserve Bank of New York began publishing it daily in April of 2018, and it gets published at 8:30 a.m. Every banking day. It actually reflects 3 overnight U.S. Treasury repo transactions. And I think it's through the machinations of computers and algorithms and the like. But it's based in, keep in mind, it's based solely on that transaction data. It is not based upon human judgment, but rather looking at this huge array of deals. The numbers that are quoted in the literature say it's $600 billion in transactions done on a daily basis. Now, the expectation is that it may well only replace U.S. LIBOR, and thus LIBOR replacements for other currencies are going to have to be proposed. They already are moving forward in that direction in Japan and other jurisdictions. But keep in mind, these repos are really effectively secured transactions. So the level of risk in these transactions, and thus, of course, the price negotiated for these transactions is going to be less than the unsecured transactions that were the basis for determining LIBOR. The result, I think, is that the expectation is that SOFR is going to be more stable than LIBOR, and that the likely spreads for the margins or the applicable margins or the interest rate spreads will need to be adjusted to make LIBOR and SOFR actually mesh together, at least on a transitional basis. Wanted to underscore this stability thing. I think someone has done a study of looking at how SOFR rates, if they had been determined in 2008, 2009, how they would have correlated with LIBOR. And the reality is they would have been much more stable over that period of time. I think many of us can remember that rates were spiking up and down precipitously on the LIBOR index during the financial crisis. So keep in mind when we're talking about, what I've been talking about to this point is sort of the theoretical stuff and how LIBOR and SOFR are going to be determined and whether or not we're going to use one or another. But in the commercial lending context, the choice of an interest rate index is really just one of the many contractual provisions that is subject to the agreement of the parties. Now, what we've seen since July 2017, when the concern about LIBOR going away arose, is that people have looked at the legacy loan documentation that they have in place. And what you'll find there is, not all the time, but in some cases, there's only a mechanism for dealing with a temporary unavailability of LIBOR, not LIBOR going away permanently, or the illegality of LIBOR, and nobody's really saying LIBOR is illegal. So the fact that there's going to be a replacement for LIBOR, or that it'll go away completely, is often not accounted for in loan documentation. Now, in most cases, there's some kind of an alternate rate, like prime rate or base rate, and oftentimes base rate has a LIBOR component. But if LIBOR otherwise goes away, it's going to go away for that base rate as well. So you're going to be looking at a base rate or a prime rate that is based upon the prime rate and or the Fed funds rate for determinations. And as I said earlier, those kind of rates tend to be more dictated by either financial institutions or by governmental authorities, central banks, that are not as responsive to the market as LIBOR has been, or that would be as responsive to the market as SOFR is. There are even some legacy agreements where the fallback is that if LIBOR goes away, we'll just continue to use the last LIBOR rate that was quoted. That kind of turns what everybody thought was a variable rate facility into a fixed rate one, far from the contemplation of the parties when they put their deal together. So a couple of approaches on new transactions and amendments to legacy deals. One of the things that's important is to have a clear trigger on when that replacement index is going to come in. For example, if ICE actually announced we're not going to issue LIBOR quotations going forward, that could be a trigger event. Another could be a regulatory authority saying that, for whatever reason, LIBOR doesn't work under that regulatory authority's view. So that's the kind of clear trigger that ought to be the basis for moving to a replacement index. It ought to be specific enough so that the index rate can really be identified and then can be applied. And ideally, it would minimize market distortions so that the parties don't find themselves in a situation where either the lender wants to get out of the deal or the borrower wants to get out of the deal, and they start shopping around for other deals after they had settled on what they thought was a pretty good arrangement. From the lender's perspective, there's a few ways in which this is now playing out. One is that they simply say, well, we will deal with whatever is published in the future as a successor to LIBOR. It could be by ICE or it could be by ARC or whatever, but there's at least an agreement in the documents that whatever is published in the future will be whatever is published as a replacement will be the replacement index. The second is to provide a lender with considerable discretion as to identifying a new rate, and we do see this in a lot of documents, where the lender gets to determine the successor rate that will be applicable. A third one is where it's done by mutual agreement between the borrower and the lender. And this we've seen in a lot of, the syndicated market, I think, has generally fallen to this approach lately. And that's a situation where the borrower and the lender would come to the table, they'd negotiate a replacement and move forward on that basis. Now, of course, as lawyers, we all know that sometimes that doesn't happen, and so you have a falling out, there's not an agreement, then what happens? In most of these documents in this amendment approach, there's a fallback again to some other index like the prime rate or the like. That again creates the kind of distortions that I talked about in the earlier slide. I will note that I think the approach on this amendment strategy, including with the fallback if an amendment isn't reached, I think has gained pretty wide market acceptance in the last year and a half. Erik and I were just looking at a transaction last week where the borrower had significant leverage in the transaction. It was sort of along the lines Peter was talking about earlier. But it's remarkable to us that when it came to this particular provision, they really tracked the market standard that I was talking about, and that amendment approach is what they followed. One other approach that has been considered, but I haven't seen it adopted any places, what they call a hardwired approach. And that would say that if SOFR, for example, became accepted in some quantity of transactions, sometimes it says as few as 2 is at least the proposed language, then SOFR is going to apply going forward. But I don't think unless you otherwise have been able to fix the margins, the spreads, and otherwise gotten comfortable that SOFR is reliable for these purposes and has future periods, I'm not sure how that is going to work. And at least in my experience, I haven't seen that in the transactions we've looked on. So again, from the borrower's perspective, it's important to address the margin distortions and really to try to get a seat at the table. Because, again, as I said earlier, if things get too far out of line, the borrower's going to want to walk from your deal, and the bank's going to want to walk from the deal, and that's not what they entered into in the first place. Just to wrap it up, a couple of problematic areas. Syndicated loans generally, and we've been talking about those, but if you are looking at what you're going to do to deal with replacement LIBOR in a legacy syndicated deal, you're going to have to make sure that you know how many of the lenders have to assent to the change. In many syndicated deals, changes in interest rates require unanimous consent of lenders. And then there are these other areas, securitized loans. There's trillions of dollars out there, and those are somewhat problematic. A lot of them are going to run off before 2021, but if they are sustained past 2021, how are you going to go out to thousands of consumers' transactions who went into those securitized transactions and get amendments? And then swaps as well. Lots of swaps are geared to LIBOR pricing. ISDA is working at coming up with replacement language and a replacement approach, but that hasn't been finalized as of yet. So that's a quick run through on LIBOR replacement. Any questions on that topic? Andrew.
I had a couple. Two-parter. First one, just curious, SOFR being an overnight structure structure? Has there been any talk? I haven't found much in the way of building out a tranche structure, multiple tenors, 1, 2, 3, 6 month type tenors. Secondarily, given the derivatives market, really outpacing the syndicated loan market. I think syndicated loan market last year was 3.5 million, something like, or 3.5 trillion. Sorry. Wouldn't you think that ISDA would really kind of drive the process of what that replacement rate might be?
Yeah. to remind me of your first question. Sorry.
The tenor structure.
The tenor structure, right. So ARC is looking at that. They recognize that obviously not everybody's going to want to price loans on an overnight index basis. So they are looking at how to figure that out. I haven't seen any literature yet on how they're going to do that, how they're going to extrapolate from an overnight rate to a 1 month rate to a 2 month rate and so on. With LIBOR, the bankers told them, well, this is our rate for 1 month, this is our rate for 6 months, this is our rate for 12 months. So they had, imperfect as it may be, they at least had a resource to tell them what those rates should be. Currently, that overnight repo rate, while it's very sensitive to the market, doesn't give you those extended periods. And then what was your second question, Andrew?
Second one, I think the derivatives market.
Yes.
North of 90% of the overall LIBOR market. So.
Yep. No, and ISDA is work. I mean, I didn't want to go into that for this session because this is more about commercial loans. But ISDA is very active in trying to fix the problem and has been coming up with a number of proposals to the market participants. So that's ongoing. And again, there may be some swaps that are long enough term that there may not be a real good fix for them. Anything else? Okay. With that, I'll turn it over to Erik Detlefsen on syndicated transactions.
And I feel a little bad because to keep you on time, you're only going to get 10 minutes of this delightful little topip here.
But Erik will be here afterwards. And
I'll be here
for 3 hours if you want to talk
with
to
your
him
questions for as long as you want. But so what we're talking about, and you've heard this term syndicated credits bounced around here, and frankly, I think a lot of you are probably familiar, but just to make sure they're not talking past anybody, I think what we're talking about is a credit structure where there's a credit facility being provided to a borrower, and it's under a single loan agreement, right? But there's on the lender side, multiple lenders, one of which is serving as an administrative or some sort of a documentary agent. There can be different permutations in all of these things. There could be different tranches, or there can be multiple agents. But ultimately, it's single loan agreement, multiple lenders, and then some entity or institution serving as the administrative agent role. And I think what I kind of want to zoom in on and talk about is the process of reviewing the credit from the perspective of the member of a syndicate. So you're playing that role not as the administrative agent, but in the position of a syndicate member. And what we call that at Dorsey is a syndicated credit review. It's a kind of a 3-part. You're reviewing the credit agreement ultimately for compliance with the credit approval. Also then internal policies and procedures that the bank may have. And then if there's intersections with applicable bank regulations that might need to flow through the credit agreement. I think one, I guess, kind of a marketing plug, we intersect with this review in a couple different ways. A lot of you in the room are with large, or on the phone, or are with large institutional lenders. You have in-house, frankly, folks who do this on a full-time basis, this type of review. For those clients serve as kind of an overflow counsel when times are tight and the deadlines are very fast. But then also we will help other lenders, and there's no size restriction, I suppose, who are participating as members of Syndicate develop policies and procedures themselves. We've helped a number of lenders in that posture. And I think, kind of jump in, the reason it's important to kind of think with this lens on, or with a different hat, is as a member of a syndicate, you're not involved in drafting the loan documentation, right? So the lender that's serving, or the entity that's serving as the administrative agent is doing that. You're not always aligned as a member of the syndicate with that party. And I guess even just at the documentary stage, you've heard all this discussion. So you think about what is of interest to a syndicate member. Frankly, everything that's been discussed, right, is of interest to a syndicate member. But the administrative agent may have a different determination of what is a market deal for a borrower of this type, right? So when you pick up the document in light of your credit approval and your underwriting paradigm as a syndicate member, it may turn out that when you open the document, you find covenant light and you didn't have that view of the borrower, that this is a borrower deserving of a covenant light structure, that there should be a little bit more oversight and a little bit more of a hair trigger approach to credit deterioration. Some of these things, kind of at a high level that we really like to look for when we're doing these reviews, you see them here, but there can be a different approach depending upon what the lender views on the front end. But then also, and frankly, as much with more significance, as the credit is performing, performance can go in a couple different ways, right? The borrower could be highly acquisitive and might be performing well, but desire to engage in significant acquisition activity, or things just may not go as planned, and there may be a credit deterioration. In that case, perhaps the fee and the economic realities of the administrative agent's position put you in a slightly different position versus as being a syndicate member, right? And so your willingness to live with a slight credit deterioration, there's going to be tension there. So who then, and I think one of the ways, as kind of want to dig down into the weeds of what one of these documents looks like, and just by way of reference, these slides, obviously we're not going to talk about a lot of this. There's a bunch of examples of kind of the things when you're wearing that hat as a syndicate member, what should you be looking for? There's kind of a menu of things in the back here. One of the things that, and this is fundamental to the structure of the transaction, is this concept of required lenders. So talking about a bilateral credit structure where you have a borrower and a lender, the decision maker on the lender side is the lender and the lender's credit committee, right? That changes. It becomes a little bit more bureaucratic when you go to a syndicated credit structure. And so what you're looking for in the documents is defining who is the decision maker on these key items, waiving an event of default or changing the interest rate, or these, which hopefully is not able to be done unilaterally by the agent, but it could be, right? I mean, you can pick up an agreement and suddenly see, oh my gosh, the administrative agent has authority to change a bunch of things. Or, and this is bad in a different way, but maybe it requires unanimity of the lenders, right? When I've been involved in both documents, I've picked up a credit agreement in a workout context and seen that there's 3 lenders and the definition of collectively the lender. And so when the lender has to exercise remedies, it has to be all of them, right? And you're never going to get everybody to agree on something as fundamental as exercising remedies. So having there be a definition that clearly explains when these material things can occur is going to be essential. And, we can jump to the next slide. You want to think about, and so this is just, again, as we start to drill a little more specifically, wearing that syndicate member hat, you got to think there's not a one-size-fits-all approach. You might have a deal where there's 20 banks in the syndicate, or Peter referred to a club deal, right, where there's just a couple. If it's 3 banks, you might have a bank that's taking a 60% hold and your other 2 are at 20. If the required lender's definition is a 50% threshold, well, now that entity that's serving as the administrative agent can just steamroll and do whatever it wants. So there's an example down in this proviso in the definition of required lenders here where it says it should at least be 2 lenders, or it should, and I guess the example here is just to say, if you think things through on the front end, develop some sort of a robust checklist or procedure for reviewing these types of credits, you can avoid some pretty sticky and really frustrating situations on the back end. And it may be that you determine you don't need to make this change even though you have a club deal because, look, you're just aware of the relationships, right? But you certainly want to process those things from a risk management perspective on the front end. And so thinking them through on the front end is going to cause you at least to be aware of the issues that you're going to have potentially on the back end. I want to think through, we can talk about I could talk to you about this for 4 hours, right? I mean, this is, these checklists are long. Actually, it's kind of a fun process when you dig into the weeds on some of these sometimes. Jump over to the slide reserved matters. So, yeah, go back.
Back one.
So the credit agreement's going to typically provide, right, that the required lenders can amend a credit agreement, right? So it's not the administrative agent. As an aside, I once was doing one of these syndicated reviews, and what can happen is if the form that was started from was maybe a single bank form and then they bump it up into an agented form, you can get these inconsistencies where I look at the opening line to the covenant section and it says, unless the administrative agent shall otherwise agree in writing, comma, the borrower shall do X. Well, suddenly you might have an amendment section that says, okay, actually, if we want to waive a provision or amend a provision, it requires required lender approval. Well, but the negative covenant section just said administrative agent approval, right? So unfortunately, when you're dealing with a couple 100-page contract or a 150-page contract, you do have to drill down with a process to understand, to make sure that this list right here of provisions that should require every single syndicate member to sign off is pretty well received in the market and is pretty rigid. But there can be ways that can be cut into or neutered a little bit that you need to get ahead of by reviewing. And I guess the same thing could be done on each of these slides. And as much fun as it would be to play this what-if game of wearing the hat of a syndicate member, I think you get a flavor for it, right? It's with some planning on the front end and understanding that your interests are generally, but not always, going to be aligned with that administrative agent. You can kind of see and understand your risk profile going into one of these documents as a syndicate member. But yeah, I mean, and play along if you want to read through any of these and have questions or something piques your interest. This is not an exhaustive list of the issues that I would look at or that we would advise you look at in a syndicated credit review. But as you have questions, I'm around. We have emails and phones that work and they ring often. So we love to hear from you guys. So if there are any questions, feel free to raise them to any of us.
Well, if there aren't any questions now, as Erik just said, feel free to contact afterwards those of you who are on the webinar or on the phone or in the room here. You can find us here at the Dorsey office in Minneapolis, where we are all in residence, and we'll be happy to take questions from you. Again, thank you for coming today and for participating in this roundtable. We will have another roundtable with a topic to be determined. I think it's actually been determined.
It's been determined.
I just don't know what it. Jay, do you know what it is? California privacy law and how it intersects, I think, with the European privacy law regime and so forth, which might sound like, gee, we're just in flyover land. Why would it have anything to do with us? But I think you might find it to be an interesting program. So thanks again, and please reach out to us if you have further questions, and we look forward to having you at our future Bank Council roundtables. Thanks.
Thank you.